You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Ladies and gentlemen, please welcome to the stage, Ed Mazzola.
Good afternoon, everybody. Welcome back from lunch. Thank you very much. I hope everyone had a nice little break there and is fueled and energized for the rest of our sessions today. 2 more panel discussions for you this afternoon, the first of which is going to discuss emerging technologies and advanced analytics, so this should be a good one. Before we get to that discussion, I want to bring up the sponsor of this session. Karen Timmerman, Director at Bank of America Prime Financing, is here to say a few words and bring out the panel. Let's give a nice welcome to Karen.
Thank you. Hi, everyone. My name is Karen Timmerman, and I'm at Bank of America Securities, and we're excited to be sponsoring today's panel, Emerging Technologies, Advanced Analytics, and Automation and Options Trading. Our panelists today will be discussing how cutting-edge technologies have transformed the options trading landscape, enhancing the decision-making process, and driving automation of trading strategies. Our moderator today is Ivan Brown. He is the Chief Operating Officer of IEX Options. So with that, let's welcome Ivan and our panelists to the stage.
Perfect. Well, thank you. Good afternoon, everybody. It's a pleasure to welcome you to today's panel on emerging technologies and automation and options trading. First off, I want to extend a sincere thanks to Tricia and her entire team and the OCC for putting on a great event. And let's get to it. So technology is a foundational component of everyday life, and that's certainly true in options trading as well. It continues to profoundly shape our day-to-day reality, shaping and creating scale, driving efficiency, and at times also creating complexity. Whether it's low latency infrastructure, real-time analytics, machine learning, or AI more broadly, the tools we use are transforming the way we trade, the way we compete, and the way we serve end clients. Today's panel brings together leaders from across the industry, each with a unique perspective on how technology is applied and continues to evolve within their respective worlds. We'll explore what's driving innovation, where human judgment still matters, and what lies ahead. So gentlemen, thank you for joining me. Why don't you quickly introduce yourselves, and we'll dig right in.
Sure, I'm Steve Crutchfield. I'm head of business development with Chicago Trading. We are a proprietary trading firm mostly focused on options market making.
My name is Joe Mazzola. I run derivative strategy at Charles Schwab, assuming you know that that's a retail brokerage firm.
I'm named Pomeroy. I work for Wolverine Trading Technologies, and I cover WEX's options smart order router and our exchange relationships.
Awesome. Thanks, guys. Well, let's scene set. So each of your firms plays a distinct role in the options ecosystem, whether it's providing liquidity, aggregating and routing order flow, serving end investors. Let's start off with how does your role within the respective industry shape your current technology needs, and what types of technologies are most critical to your business today?
You want to left to right?
Kick off?
Sure. Yeah. Okay. So options market making. I was joking with Ivan backstage. Why is technology important to a market maker? Why do you think it's important? The story is pretty straightforward, and I would kind of divide it up into maybe a couple of buckets for purposes of this conversation. They're kind of the new and exciting things that have emerged very recently, which maybe we'll come back to. Mm-hmm. And then there are the things that have always been true but are sort of maturing. So as an options market maker, what do we care about? We care about pricing, execution, risk management, and operational soundness underlying all of that. So we want to make sure that our systems are up, they're running correctly in a monitorable way so that we get appropriate alerting if things break. We want to make sure that we've got the real-time price feeds, that they're delivering data in a timely manner, that we're fast enough to respond to those based on the signals that we have built, which are our bread and butter. We're a pretty highly quant-driven, kind of vol forecasting focused type of market maker. And so the way that we express those needs evolves, of course, and mostly in the technology space, as everyone here is aware, a lot of it has been about being, better, faster, more reliable. So certainly, for example, our execution infrastructure, I don't think it's a trade secret, but a handful of years ago, you could do a lot of it in software. You can still do some of it in software, but you kind of move to FPGAs, which are these programmable devices that are kind of a general purpose a bit of kit, and then maybe some firms, or in some cases, move to using ASICs, which are application-specific prefab, less general purpose, better suited to purpose devices, and I think a similar thing has happened on the market data side with a movement from getting market data over a wire to getting market data over microwaves to lasers or whatever the next thing is. At some point, you're limited by the speed of light. So. That's kind of the spectrum of use cases, and what we and I think all of our competitors have been doing for since the beginning of electronic trading is trying to just kind of chase each other, making every little step in that pipeline faster and more efficient.
I mean, you can imagine from our perspective, with option volume doubling and with 37 million client accounts, the most important thing for us to do is be able to kind of facilitate those transactions, right? So not only is it trades, not only is it orders, not only is it kind of access to risk management techniques for the clients, but I think one of the things that's become more and more apparent is really the expiration cycle and the settlement tools, and so that's something that we've been concentrating on. And we've expedited that to the point to now where we've speeded that up 100 times. And so, as the more and more of the zero DTE becomes more and more of a retail trading product, which it has become, and as we continue to see that, that's very important for us to provide that access and that ability. I would say the second thing is really in terms of like risk margin. So Span 2, the integration of that has really kind of helped us identify for not only client risk but for firm risk as well too. Where margin becomes a big issue. It helps us not only with that, but it also helps us to provide better risk analysis techniques and better margin capabilities for our clients. I think that's something that is really going to expand our capabilities as we go forward.
For the order router and the wholesaling business, I think maybe one of our more high areas of focus and concern is over the order management lifecycle. So executing or managing orders equivalent to something like 10 to 15% of the option space on a daily basis. We'll have orders of various kinds, whether they're complex or simple, or stops or things like this that where we have to place child orders over the course of the day, maybe re-optimize or remanage those and communicate that life cycle back to our clients. Our goal is always 100% uptime, and so a lot of our focus is on redundancy and being able to smoothly transition in the case where any number of the sort of points in the system chain fail, whether that's the exchange, whether that's something upstream on the client side, and being able to effectively develop real-time analytics to kind of be able to target to exactly who our client base that's affected, exactly what's going on and communicate that effectively.
So, maybe a question for maybe Steve and Nate. So, no doubt ton of growth over the last 5 years. Options gone through a lot of change and evolution. As you think about sort of your application of that technology, how has that evolved over the last 5 years? And is it post-pandemic? Is it the retail trading boom? Is it a sort of a regulatory catalyst? Sort of what accelerates those types of developments, or how do you think about that?
Well, I think a lot of it is the type of technology that's available, off the shelf, I guess, yep, for lack of a better term. So example I would use is the vast growth in use of cloud-based data solutions, yep, cloud compute over the last, 4 or 5 years, really, I think is when we, at least, and I think others were probably ahead of the curve here, but and it brings some unique challenges. Obviously it's great. We're able to do wonderful things with the cloud. There's also this, you can certainly drown in data if you're not smart about how you use right, it, and also what you pay for it. I think one thing that was a little bit I don't know if funny is the word, but we certainly at our firm, we learned a lesson. Our ability to provide powerful cloud-based data sources to our quant traders to come up with alphas, to run back tests, kind of unintentionally outpaced our ability to put controls around it, monitor it, and make sure that we're not paying too much for it, right? And so I think I've spoken with a number of folks who I think have had similar stories to tell. But one day it was kind of like, hey, we have this cool stuff, and people are like, I'm fine. I'm kind of, I like doing things the old. I got my Excel spreadsheet. It's cool. And then after a little while, all of a sudden, there's kind of this, socially expanding group of people who are really using these tools. And then one day you look at your cloud compute bill and you're like, oh, we created a real, I think it's called the tragedy of the commons, right? It was like all of a sudden everybody could just grab this stuff, run with it all day. We were having these gigantic processes like, whoa, we got to get this under control. Now let's try to intelligently scale it back a bit. So certainly it's not just about adopting the tech, but also creating the right processes around it.
Well, every new trader is going to implement the model that's going to figure out all the right trades and not make all of those and not make all the bad trades.
Are you selling those right now?
They just need the right amount of the compute cluster, which is the whole thing.
How about for you, Nate? Any thoughts?
I think Steve could comment on this too, but with the growth and volume in the options business, both market makers and also wholesaling market makers are being handed a position by the market that's larger and less spread offable as expirations become more distinct, whereas maybe historically you could trade in and out of the monthly and you would expect over the course of several days that flows would offset. Risk managers have had to develop way more sophisticated tools to manage into the positions that our customers are handing to us. And we have price improvement basically obligations to our customers to deliver over and above the NBBO. And so we're sort of expected or handed a book of business that we then have to trade around every day. The other piece of it for our institutional side is just developing additional complexity for our algos. And there's been a lot of appetite for institutions, large banks, hedge funds, other types of traders for Vega and vol-based strategies that are increasing in sophistication every year.
I feel like on our prep call, we talked a little bit about how technology helps us think about corner cases. I don't know, Nate, if you have thoughts on that, just in terms of how that's evolved over time and our ability to detect those types of things or sort of forensics and such.
Sure. So I guess corner cases, one thing I would think about with corner cases is there, as we know in this room, a lot of corner cases in options markets from every permutation of the orthogonalized data space that you can think of. Right. And without normalizing or transforming for outliers and for performing data analytics, those are going to completely destroy or dominate the model that you might be trying to apply to any given purpose, whether or not I think I'm going to detect an anomalous behavior where a customer is trading differently than they were before, right, or it's something on the market making or theoretical value and risk management tool side.
I mean, I think that segues nicely in terms of sort of like the genesis of some of this order flow. Disclosure volume went up a lot over the last 5 years. I think we've said it enough times, but in case we reference it again. So Joe, really interested in your perspective. How have the retail firms adapted their technology to handle those increased volumes, just like from a functional point of view? But then like, how is your customer evolved, or what does your typical customer look like now, and what are their technology needs or expectations?
Sure. So I think one of the things that has helped was kind of the automation of the daily settlements, right, with the OCC. I think that's huge. That used to be a manual process, and now it's automated. And when you see the additional order flow that we're seeing on a daily basis, you have to have that in place. And that allows us to ramp up scalability. So we're not just thinking about today's clients, we're thinking about the clients 5 years down the road, and we're thinking about whether or not that continues to grow exponentially. I would say, with the amount of clients that we have, it is kind of hard to pigeonhole their needs, but there's a couple things that we see coming across the board. Continues to be more of an adoption of mobile trading that continues to explode. So having tools that meet the clients where they want to be met on the mobile side, we continue to expand Thinkorswim Mobile. There's a lot of risk analysis tools that are built within that. And as you were mentioning, Steve, there's a lot of off-the-shelf things that when you're looking from a premium perspective, and I don't mean option premium, I mean premium in terms of people are willing to pay for this stuff. The way that we try to intersect that is we say, hey, that's a great model. Let's try to make it that available and give it to you for free. And that is one thing that we know that our clients really appreciate, is that we continue to expand on that. Now, I will say this, with there's a difference between cool tools, right, and the things that can really, really help. As we continue to see more and more clients adopting portfolio margining, I think that is kind of that next frontier of where we can really help them identify their risk points, whether it's expansions and volatility. Here's another thing. 5 years ago, retail clients didn't care about gamma. They didn't know what gamma was. Yeah. Now with everybody, trading short-term 0 DTEs, they better figure it out pretty quick. And so one of the things that we've done is we continue to expand our education offering. We have Schwab Coaching, which is one of the groups that I run, where we have 30 hours a week of available coaching on YouTube. We have our Schwab Network, where we talk trading strategies. We do live events, similar to where we're at right here at the OIC. And so these are different ways that we can try to meet from a trading, from an education, and an execution standpoint.
And I'll add on the retail sophistication side, Joe, 2 hot button issues or talking points that have come up with our retail customer base, even in this conference, and are kind of active challenges for the industry related to this retail sophistication are one, account fraud, in particular in the options space, which has been prevalent, in particular in the past year, where someone's illegally taking ownership of an account in retail client A, they transact with retail client B to essentially move the funds and then exit that position. That's a live issue that I know our retail counterparties really are concerned with. And a second sort of analogous concern that affects the wholesaling side of things is what we could call pro-tail, or highly sophisticated, usually API-based traders that are essentially targeting highly illiquid options and availing themselves of wholesaling liquidity because of the large amounts of price improvement and execution quality that we're providing to our clients. So those tools and those that sophistication has a lot of really obviously bright spots for the industry and has led to a lot of growth and a lot of benefit to everyone in this room. But there are challenges that are coming right hand in glove with that improved retail sophistication.
Yeah, I think that comes into sort of like the notion of the double-edged sword of technology, right? So technology is both an enabler of innovation, it creates scale and things of that nature, but it introduces complexity in that way. It also potentially creates competitive burdens that you guys all have to manage, right? So how do you sort of balance, what's your thought process for balancing leveraging these cutting-edge tools to unlock value while managing sort of the continuous pressure to upgrade or adapt to competitive threats? And like what's fun and interesting versus value additive?
I'll kick it off if you want. For us, job number one is scalability, right? We have to be online. And I know that seems like a simple answer, but when you have a flood of overnight trading, now we've gone 24/5 now. For a few months, we have access to all the S&P 500 stocks, access to all the NASDAQ stocks, access to a myriad of ETFs. And so that overnight flow is really starting, that volume is really starting to pick up. So you have to make sure that your clients have access to that overnight trading. You have to make sure that they have access to the opening rotation, all of that. And there can't be any hiccups along the way because it's a very competitive space. Clients don't necessarily move for a nickel difference in commissions. Clients will move for the fact that if you screw up on a day when they want to trade and you're not up, that's when they'll move. So you got to make sure that you've bumped up that scalability to handle the inflow of new clients. And we continue to build that client database. Like I said, we have 37 million, and so we can't just think about what's going to happen in the next 2 years. We've got to think about what's going to happen in the next 10, 15, 20 years to make sure we can meet that demand.
Yeah, no, that capacity planning is something that I think we all think about, right? From an exchange point of view, from a market maker, retail point of view, what is the next volume environment look like? And in many respects, sort of this continuous, growth, what is that next, 2, 3, 5, 10x sort of overhead that we want to think about to sort of manage to, right?
We just got stress tests in April.
Yeah.
Yeah. Go ahead.
No, go.
I was gonna hand it to Steve as well, but with respect to like WEX, like we have to connect to every exchange, and there's a sort of static cost to the industry that we're incurring and that other retail or executing broker dealers are incurring as the proliferation of exchanges grows. That's a sort of deterministic fixed cost that we're all incurring. And then, on the market making side, obviously there's a sort of table stakes requirement for the amount of, frankly, physical capital that you're pouring back into your technology, to say nothing of the amount of human capital that you need to invest to keep up. And I'll leave that to Steve, but I think, probably where the you balance the sword is maybe a little bit more on being more intelligent about the human capital that you deploy and being smart about how you design those systems rather than whether or not you're going to buy them.
Yeah, those are all really important points. I mean, certainly, and you touched on this, excuse me, there's, for a variety of reasons, both, we've talked in the past about strike proliferation. I think a lot of good work has been done on that the last couple of years, but there are a lot more strikes. There are more optionable products, which I think is generally a good thing. There's been an explosion of ETFs. There's been an explosion of exchanges, which I'll come back to in a second. So a lot of things driving massive increases in the amount of market data that we all have to process. I have some weird scenario in my mind where, like, well, let me start that sentence over again.
I want to hear the scenario. I'm really interested.
I'll come back to it. It's not that weird, but Ivan, your old boss and mine, Ed Boyles, used to say that low latency trading race to zero. It's kind of a giant annual subsidy from the trading industry to the technology industry.
Yeah, 100%.
Right? And the weird scenario I was going to say is, I mean, you could sort of imagine, like, if everyone just sort of stopped competing along that axis, then we'd all save a bunch of money. Of course, that'll never happen. It's always someone's comparative advantage to be a little faster than the next guy, and so we all end up. This is just the world that we live in. I do think one factor that contributes to rising costs and complexities for market makers, and I know nobody thinks like boohoo the poor market makers, but ultimately costs paid by market makers make their way slowly through the pipeline to end users and to everybody. But it is the issue of exchange proliferation. I mean, we're going to be at 20 exchanges next year. I think a few years ago, anybody had said we'd be at 20 exchanges would say, well, that's kind of silly. Why would there? And there are reasons for this. They're kind of structural incentives that exist artificially to further fragment the exchange landscape. One of them, pet topic of mine for some years, is the ORF, the options regulatory fee, which I was very happy to hear Commissioner Pierce speak about the other day. And I'll just mention now, NASDAQ has a proposal out, which is very interesting, and everyone should judge it, based on their own view of the merits, but I think is worth a look, which would move us toward this shockingly rational idea that exchanges should only be able to charge a regulatory fee for business that's actually transacted on that exchange. Seems like a reasonable thing to do. So I think that's potentially a step in the right direction that could help with a piece of this challenge.
Yeah, no, I mean, it's an interesting balance that you're creating, right? Like when you think about exchange launches, sort of like you have to think about the incremental cost that it creates for the industry in comparison to the incremental utility. And to the extent that you have a differentiator, you can add incremental value, you can help keep that balance in line, right? But at the end of the day, strikes are strikes and exchanges are exchanges, and market maker capital doesn't grow linearly with either of those two things. So I think together as an industry, obviously we need to be considerate of those factors to make sure that as much capital is deployed into the quote for the end investor as possible. So, but I think, Nate, you made a really great point, which I think, can help us transition into the sort of next chapter of the panel, which is how do we be more intelligent or potentially more intelligent about the way in which we deploy human capital? And that sort of like raises the question of AI and machine learning, and I think that was, a theme that was touched upon, with our keynote speaker earlier today. And so, let's just set the scene a little bit. So, I mean, AI and machine learning obviously are very much in vogue and widely discussed. But, practically speaking, especially since it's at its early stages, where have they had the biggest real-world impact in options trading for you guys today? And maybe to help contextualize that, sort of where do you see the limitations or challenges in applying these technologies effectively? So maybe, Steve, you want to kick it off with a little lesson on the distinction between AI and machine learning?
Sure, I'm happy to speak. I don't know if I'm qualified to give a lesson, but
no one's an expert in AI, from what I understand. We're all learning together.
Maybe some people here probably are. But
ask ChatGPT.
you guys can inform me better after the panel. But I mean, certainly the way we think about it. First of all, just something I said in one of our pre-calls is there is a little bit of label inflation that happens, and for obvious reasons. I mean, there's marketing, and AI is super trendy. But I've said internally in the past, it feels like half the time people say AI, they mean specifically machine learning, and in particular some aspects of machine learning that feel much less like AI, like running a lot of fancy linear regressions. Yep. And by the way, I think half the time people say machine learning, they mean more basic data science, and half the people say data science. Half the time people say data science, they mean like what we used to call statistics. Remember that? I remember the first time somebody told me they were a data scientist. I'm like,
they were doing fancy math.
It's fancy math.
Yeah, fancy math.
It's fancy math.
Yeah.
But obviously there is a lot of real innovation in the space as well. I mean, the way that I think about it, at least, is AI is about mimicking human intelligence. There are a lot of ways to do that. I'm old enough. When I was in grad school, I studied computer science. We use non-machine learning based AI. It was rules based. It was expert systems and probabilistic natural language processing, where you're not trying to build a network that learns something in order to then apply it. You could point to the rule and say, oh yeah, this rule triggered based on this input. Things are obviously very different now. So machine learning, ML, is a set of techniques that are critical to AI, but are specifically focused on gleaning inferences from data, and that includes, again, these neural networks and these modern transformers with attention, right? Very innovative ways that we can build things like LLMs, that's a different thing.
LLMs. That's a different thing, but equally useful.
We don't need AI for that, yeah. But also very important. But also machine learning can include, again, as I referenced a second ago, things that don't feel like AI at all, which is, I feel like as somebody who, part of my job is to review new business opportunities for CTC, and certainly frequently am pitched on something that, like, hey, look, I use AI to run this trading model, and you look at it and like, no, you fit a line through some points, and right, which could be good. I mean, there are a lot of good alphas that look like fitting a line through some points, but let's not call it AI. I'm sorry, to answer your question.
I mean, it was a lovely discourse.
Okay.
Yeah, right. If you wanted to keep going.
No, I'll pause there for now.
Yeah, I mean, go ahead, Nate.
We can keep complaining about junior traders for sure. I mean, so I'll add to what you just said, Steve, which I think was right on the money, that the line and the points, it's garbage in, garbage out, and a lot of what I think quantitative trading firms actually spend their time on is being really intelligent about problem selection and what the actual objective function of the relevant risk or theoretical value characteristic they're trying to quantify is. Because at what time horizon you exit a trade, how you're hedging that trade, and what trades you're relating to it are really the most fundamental and challenging problems of quantitative trading strategy. And those are not well specified, and you can't just say like, okay, I'm going to exit in 5 minutes or something like that. Where I think a lot of the PhD brainiacs that are actually spend their time behind the scenes at these trading firms is thinking really critically about what the variables are and making intelligent decisions about what data to ingest and how. And that's really beyond the scope of what the model, handing that to the model. That's before and after handing that to the model and making intelligent decisions about that.
So what I would say from a brokerage side is, I think at some point you will see AI make its way into some trading tools for retail clients. I think that there's still some challenges in terms of compliance, FINRA, whether or not you know your clients. But where we've adopted it already is more so on the customer support side. And that's been really interesting because it helps us with priority, with triage. When there are questions that come across, we have the Schwab Knowledge Assistant. And what that allows our frontline members to do is, as a question comes in, it can route them to answers very quickly, which really expedites that customer service process, helps them understand the question and adapt and answer much more quickly, which helps control the call volume, which helps reduce those times, and which helps our clients. Ultimately, they benefit in the end because they get a quicker response time. So that's where we've adopted it right now. We've seen a lot of success with that. As I mentioned, there's a lot of off-the-shelf products right now. You see them on Instagram or you see them wherever, where they're saying, you throw this AI into your trading software and it'll make you print your money. Be careful about those. Those are my thoughts on that. But it's only a matter of time till you start seeing more adaptation on the trading side from the retail public with that.
I mean, just a thought. I mean, do you guys think that sort of the framework in terms of the expectations around the return on AI is sort of out of whack in terms of like, hey, you know what? It actually is very good at maybe not obvious, boring things versus, obvious and cool things. And maybe if we thought about it more of like, how do we scale human capital versus like reduce the cost of human capital or things of that nature? Is that the right way to think about it from your guys' point of view? Or
I mean, I think that's how we're adopting it right now. We're not cutting staff because of AI. What we're doing is we're making them more efficient,
right,
and giving them tools to be able to access that many more client calls along the way.
Right. So how do you make a team of 10 look like a team of 100 and apply their skill set strategically where it's the most value additive?
Yeah, exactly.
I think this is a really important thread, and this came up also in the commissioner's remarks yesterday. She spoke about AI making us all more efficient, and we've talked about in the past. I think there's a bit of a public perception, I think, that many of us are using AI to solve really sexy problems, and of course AI can do remarkable things. I mean, you have a conversation with ChatGPT and you picture yourself 10 years ago. How would you feel doing that? It's weird how fast this technology has evolved, although it can also do strange and silly things that maybe we'll come back to. But a lot of what we're actually using in practice, and I think this is true, across the street, certainly there are firms that are doing very sophisticated alpha gen things with AI. But for every one of those, I think there are 4 or 5 who are using it for this automation of more mundane tasks. But it can really be excellent automation. So there are the obvious applications of, sort of like the customer service angle, but internally, right? For tech issue triage,
sure.
Basic first pass compliance, like give me the rule site on X and Y, now you got to go check it to make sure it didn't just make up a rule that doesn't exist. But that's happening less frequently. I think the single best thing that LLMs are good at is, and don't steal my secret, but writing SEC comment letters. Like, man, they'll turn those things out, because seriously, the data's all there, right? It's read every one of them that's ever been written. Mm-hmm. And so you could just say, I want to make the following points, make it a comment letter, and boom, there's Vanessa Countryman's name on the top, like the whole thing. It's amazing.
So the question is, though, can it actually get the true Steve Crutchfield tone and maybe write the comment letter in the form of a haiku?
If you write enough, sure.
Yeah. I do have some of them out there. Be appropriately supportive of IEX proposals and so forth.
Indeed.
Yeah. So that's
appreciated.
That's yeah, sure. So that's out there. I had another example that I liked, which is I spoke to someone at a hedge fund a little while ago who similarly to some of the work that I do is looking at a lot of investment theses, but they're at a major fund looking at, I don't know, 1,000 a year, many thousand a year maybe, and so they'll use Gen AI for proposal funneling, right? It's like, of course, an expert is going to make the decision, but kind of rank them for me. Let me know which ones feel like they're probably a waste of time, and I think that's something you could train a machine to do, and it's been pretty effective. So there's a lot there that isn't just the alpha gen, really super cool quant driven stuff.
And another one would be content, right? I mean, I think that's really important in terms of what we do on the Schwab network. You have the ability to maintain a smaller team and have access to content and make sure that it's relevant and it's timely and it's what's happening at that exact moment, because that's what people want to hear. They want market commentary, they want analysis, they don't want to know, what you think about what happened yesterday. They want to know what you think about what just happened. So having that ability to incorporate AI into content creation, I think, is very important as well. That's helped us a lot.
So, go, please.
Yeah, one is there's always going to be a large components of our industry that require determinism in input-output. So
sure.
With respect to clearing or risk management and functions like that, with respect to the institutional algos that WEX clients consume, they need to have a deterministic expectation of how our algo is going to handle their order. They don't want sort of a black box approach to what their execution experience is. Mm-hmm. Similarly, for clear, it's we're never going to have Mark's never going to sell to the Bank of America, team. We don't need our deterministic vol shock model. We're just going to put it in the black box and see if you fall under risk controls or not. So there's certain foreclosed paths for non-parametric modeling in general, because we do require that core explainability for these functions of risk management that are essential to our business.
Yeah, so I think, that dovetails nicely into sort of the final piece that I want to touch on. And Maurice, before I think suggested the notion of like AI won't do it for you, it will do it with you, which creates this kind of interesting tension between automation and human judgment. And we've talked about it already, right? Like probabilistic technology, that means that there's a non-zero probability of outcome being incorrect. So you think about how do you deal with accuracy to reduce hallucinations and response time or latency of the system itself. So, thinking about that, like, how do you sort of consider achieving the right balance between automation and human oversight? Where is human judgment still critical in your workflow, and how do you think about designing, the systems and teams to ensure that technology actually enhances and scales the expertise behind it?
I can kick off there with a quick anecdote I learned recently. I was listening to I wish that I had the guy's name on the tip of my tongue, but I can't remember it right now. He's an AI expert, pretty notable person in the field, was speaking about the powers and limitations of LLMs. And he gave an example that I thought was great. And kind of his point was that LLMs are really interpolation machines, and they're not yet that good at extrapolation, meaning they're really good, again, I use this comment letter example. You read every comment letter ever written, and then you kind of know how they're worded and kind of the little phrases people use, like, we got to provide liquidity, and we need a holistic review of this complicated matter, and like the stuff that people say in those things. And the same is true of any topic, but it's kind of hard to get them to go too far outside of the box. Again, speaking specifically in the LLM world, and the example was, and this is a true example, you can look this up, but a couple of years ago, you could ask ChatGPT, hey, what weighs more, a ton of bricks or a ton of feathers? And that's a common brain teaser that people ask kids, and it's on the internet, and it knows the answer. It says, you can't fool me, they weigh the same. And then you could say, okay, what weighs more, a ton of bricks or 2 tons of feathers? And it says, well, you can't fool me, they weigh the same. Because it's not able to write, like it's referencing something somewhere that's like, there are a million hits on a ton of bricks, a ton of feathers, they weigh the same. And there are none on like 8 tons of bricks and 17 tons of feathers, right? So they fixed that, and apparently the way a lot of these things are fixed, there are point fixes in the LLM models where a large number of people are paid a small amount of money to like go through and say like, no, that's wrong, right? And so that's, it's great. This stuff is getting better and smarter, but not necessarily in an immediately scalable way. So anyway, the limitations are there. I'm sorry, I got to give one more example. This happened to me last week. I had a coworker, a great guy, very smart guy, who said, hey, can you run the I-core function on Bloomberg to give me the implied correlation between some index and its constituents? And I was like, I never heard of that function. And he said, oh yeah, no, here, I asked Claude, and it said, here's the I-core function, here's how you can use it. And very plausible. He sent me the email. I'm like, this is just, none of that's true. A great suggestion if that was a real function on Bloomberg. If someone from Bloomberg is here, I recommend you should have them add that, but it's just totally made up. So the LLMs are very good at being very persuasive in telling us something that is completely untrue. And so, sorry, I'll cut myself short there. I have more, but
this isn't necessarily an AI thing, but just technology as it continues to advance. One of the ways that we've been able to use it recently is with the kind of options approval. And I'm not saying that technology is approving options, okay? So please strike that. But what I am saying is it allows us to reach out to clients that we want to take a second look at, right? It allows us to say, as more and more people want to start adapting it, and more clients are saying, I want higher levels of option trading privileges. Mm-hmm. Okay, let's use technology to find out who we want to have those conversations with. Right? Like who is close to really fitting, that mold of where we want to give them portfolio margining, or you want to give them level 3 or whatever. So you're not just going through a spreadsheet and saying, oh, click on that. I mean, it's expedited the process, and it leads to a better client experience. It also helps with risk management, tools as well too. So we have a better view into not only client risk, but firm risk, as you make some adjustments to some of the volatilities, make adjustments, to kind of, different price levels. So we can have a better kind of bird's eye view of really what firm-wide risk is. I think that right now is the best adaptation of, where we've seen technology at this point.
Nate, I think you were going to say something.
Sure. So maybe this will be a nice dovetail as well. There's a American philosopher who passed away recently. His name's John Hoagland, and he wrote an excellent book of essays, which I can talk to you about offline. But He argued in the 50s, 60s, 70s extensively about this question of whether or not AI can be intelligent or can be human. And this kind of dovetails back into the distinction between what we're calling AI now with respect to ChatGPT or LLMs or Claude or any of these things, and what it is that's unique about us. And he said in the book, he said that the reason an AI is never going to be human is not because of any sort of lack of thinking power, but because it can't care. And more specifically, he said that they can't love. Now, we can debate that offline, but if you reflect on some of the examples that other panelists already cited, oftentimes when we're engaging with these algorithms, we're actually structuring what we care about in terms of the information that we're trying to process out of it. And that applies more generally to our business decision making as an industry. Like, the way in which AI is always going to be a tool is that we're going to dictate to any sort of technological tool what it is that we care about, and structuring and thinking critically about what matters to us is what's actually ultimately driving that innovation.
No, I mean, that makes a ton of sense, right? Like, that's that sort of like just practical, pragmatic evaluation of like, what are machines good at? What are humans good at? How do you sort of interact with those two things? And I mean, clearly what you said, right? Like, with some of these things like garbage in, garbage out, like, where does a human need to get involved? Like, can it be trusted in isolation, right? You need human supervision, maybe citations to independently verify, but it's also like the humans involved in somewhat auditing the data set to ensure that the inputs that inform the decision making are actually quality, right?
I do want to add, though, of course you can't trust the AI in isolation. You also shouldn't trust a human in isolation, though, right? Yeah. So I think about, we talked a little bit in the past about black box trading systems and what's permissible and what's not. I mean, certainly the types of, we have a notion, everybody probably has a different word for it, but what we call at CTC perimeter controls, the idea being you can run a trading strategy, but you can't go outside this box. You can't take a position bigger than X. You can't trade faster than Y. You can't cross the market under the following circumstances more than N number of times, right? It looks too good to be true. Your pricing is wrong. So all those perimeter controls we apply to we call a gray box trader, which is a human sitting there fitting a vol curve. We apply them to our more algorithmic trading strategies. We would apply them, I think in a much tighter way initially, but to a more of a pure black box trading strategy, whether it's AI driven or otherwise. So I think having those robust control functions and having been very thoughtful about how to build them is critical, but that's also not new.
So we've got 40 seconds left. Quick lightning round, 10 seconds each. If we look 1 to 3 years ahead from now, your single biggest prediction of a behavioral shift or market structure development we're going to see in options. Nate, do you want to go first and work our way back?
Lots of Steve Crutchfield comment letters.
It's so easy to write them now, Nate.
Exactly.
Voluminous.
Hard to say. More of the same in every direction, I guess. The paths are clear. We're just continuing to advance along them.
Yep. Single stock, 0 DTE, small life cycles, and then how do you balance that added volume versus strike proliferation? I think those are going to be hot topics for sure.
I think we will see, keeping in the spirit of this panel, I think we will see some consolidation among prop trading firms as the cost of building really advanced Gen AI models consuming massive amounts of data to do incredibly smart things in the market becomes really, really high. And the cost of the infra, the data centers, the experts, the PhDs is going to go up as demand outstrips supply, and I think that will result in a shift in our industry.
Gentlemen, insightful as always. Thank you so much for your time and your thoughts. We'll leave it at that. Thanks, guys.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.